Hey everyone, in today's video, we're going to be talking about 3 dividend stocks that I'm looking to add to my dividend stock portfolio in the month of March 2024. We're going to look into what these stocks are, how they've been trading over the last couple months, what their earnings per share and dividend yields look like, and a bit more information about the company. So hope you guys like this video. We're just going to jump into the first stock here. The first stock is Wyndham Hotels and Resorts. So this one's been on a bit of a wild ride the last year or so with some acquisition slash merger rumors from Choice Hotels really ramping up the stock value into the high 70s. Actually went over 80 slightly a couple times, but in the last few months it's actually decelerated back down to 75 despite the broader market actually ticking up during that time period here. You can see year to date down about 5.5%, and that's mostly because Wyndham has been pushing back really hard about this merger. They don't think it's enough value that they'd be getting. So the likelihood of this merger going through is kind of starting to get priced out of the stock a bit back to where it was being valued before all these discussions took place. And for me, as someone who's been looking on the sidelines to get in at a decent price, it's actually been beneficial for me. So the dividend yield's about 1.8%. They've been increasing it every year the last handful of years, which is good, but they don't have like a 10, 20, 30-year dividend growth policy or anything like that. It's just kind of been cyclical as the business has done well. In terms of what this business is, they are a franchisor of hotel brands. So they own all of the brands you're seeing on the screen. They're very heavily penetrated in the economy, into the mid-scale range. Even though it looks like they have a ton of exposure up here, the vast majority of the actual rooms they have are really in this days in, Super 8 type of accommodation. So keep that in mind. That's really where a ton of the business is today. They're trying to diversify and expand and build doors out here. But in terms of today, you're really getting a ton of exposure to the more value conscious consumer. Vienna House was one that they bought in Europe, about $50-60 million for that brand a year, 18 months ago or whatnot. And they've actually been trying to expand some new brands that they created in-house, which we'll talk about a bit in this video. But essentially, they don't actually own the physical hotels. They franchise out these brands. They have a loyalty program and drive traffic to these franchisees, who then in turn, for using the brand and getting the traffic, pays them essentially a royalty on the room rate. So they're just getting in all of this cash flow, pretty low capex business. And I love that model on investments where it's really just cash flow in. They get to allocate that capital in a very shareholder friendly way and continue to expand the business without making significant investments on a percentage of total market cap basis or anything like that. In terms of their recent performance here, see in 2023, they grew net rooms about 3.5%, which is a pretty decent number. 66,000 rooms that were grown. Retention rate is essentially the percentage of people that are licensing their brands in terms of hotels that come back. So 95.6. I've heard them talk about trying to get somewhere between somewhere around 4% turnover. So that would make it 96% retention rate. So even though it's a bit better than the prior year, probably still a bit lower than where they want it. The reason why retention is not 100% is kind of twofold. The first thing is Wyndham is trying to kick out people who aren't meeting brand standards. You don't want to go to a mid-scale hotel and feel like you're staying at a crappy hotel. It hurts the overall brand, which Wyndham obviously has to protect. The other side is, from a competitive standpoint, I'm sure for especially the upper scale franchisees, there's Marriott's, there's Hilton's going after them, trying to get them to change their brand to their brand. So they got to navigate those situations as well. They do offset this retention rate loss of 4.5% of their network by bringing new franchisees into the system and by building hotels from scratch or partnering with franchisees building hotels from scratch. But that's just to give you a bit of color on why, if this was at 100%, it may not necessarily be a good thing, because it means that their brand requirements may not be high enough, which may have an impact on the equity of those brands and consumers wanting to stay there for future trips. They have a huge loyalty program, over 100 million members, growing really quickly. And this is really important because when they go to sign up new franchisees or ask franchisees to expand how many hotels they're running, that's a big thing that they're driving the traffic to those franchisees. That's a big reason why a hotel operator would take on a franchise, because they want that traffic that they drive. So having over 100 million members is a huge benefit for them. $500 million returned to shareholders last year. Just a reminder, this company has between a $6 to $7 billion market cap, depending on where it's trading at any given time. Free cash flow of about $340 million there. So about 18, 19 times multiple on free cash flow from last year. This is just the same thing in different terms here. Looking at some other information on this company, they highlight their 24 priorities. So you can see they want to continue growing their franchise system by 3 or 4%. I think that's a good number. Echo Suites is a brand that they've started from scratch for long-term stays. I think that's a great opportunity for them, and they continue to be excited about that. And then target higher RevPAR and royalty rate brands and across different regions and stuff like that. That's just essentially continuing to expand their fee base and their geography where they operate. So that's nothing necessarily new as we look at the last two there. They're also very interested in continuing to drive the economics for their franchisees, which is a vital part of their overall business. If franchisees aren't happy or if franchisees don't get economic value of partnering with them, then lots of the value of what they deliver is diminished. So they need to make sure it makes sense for franchisees to partner with them. It can't just be all for the Wyndham Hotels and Resorts Corporation, or else that's not a sustainable partnership model, and it'll eventually dwindle away. Talking about Echo Suites Extended Stays by Wyndham. So this is one that they just started from scratch a few years ago. They saw a gap in the market where lots of people were looking for extended stays, but there wasn't necessarily enough infrastructure. The rooms weren't set up for extended stays in lots of different states. So they came up with this brand. They've already handed out 260 sites, contracts to build essentially, and eventually these will add to their network. They already opened 12 they're planning on opening 12 hotels in 2024. You can see the runway here. They want over 300 hotels in the next 10 years across the US on Echo Suites, which is a nice little growth opportunity for the business as well, because they're just going to be generating franchise fees as well as royalties on all of those new hotels. In terms of those economics that continue to be super important, even in this environment with relatively high interest rates, 7.25%, they feel like their franchisees can be getting cash-on-cash returns of 16% compounded when they partner with them on a new hotel. They kind of generalize some of the assumptions here, but this is kind of what the model looks like in terms of how much you'd have to pay per room, and then how much you'd get back on RevPAR and whatnot, given occupancy rates and stuff like that. So you can see the brand fees and the royalty rates and stuff like that, how much each of these hotels on average are paying back to the Wyndham Corporation that you'd get as a shareholder of this company. But they also make it clear that, hey, you can still make pretty good money opening a hotel. Even if you finance it, you can still make $250,000 a year in EBITDA, essentially. Or not EBITDA, because they're adding in interest, but EBITDA minus interest. And then just lastly here, before getting into some of the capital returns, this is them just pushing back really hard on Choice's unsolicited, essentially hostile takeover, hostile merger. This is a really weird one, I gotta say. I've looked into this one a bit. Wyndham's actually a bigger company than Choice from a market cap standpoint. Wyndham has a better growth profile. So it's really weird that Choice is trying to, I can't even call it an acquisition because they don't have the capital. So it's really, Choice is trying to merge with them, even though they're the smaller company. And it just doesn't seem like it's going to happen based off of what I've read, and just Wyndham not really being open to it. They think it's going to slower their growth rate. They think franchisees kind of don't have positive things to say about Choice. That's why lots of them went with Wyndham to begin with. So they don't want Choice in control of the network, and that may cause some increased retention rate gaps versus where they want to be, and just dilute shareholder value, since it would obviously come as one big company with more shares, and you're just going to own a lot more of a business that they perceive to be lower quality than theirs. So we'll see how this plays out, but they kind of spell it out here in terms of why they think it doesn't make sense for their shareholders, and they think they have a lot more opportunity with Wyndham as an individual company. Another thing, we looked at how the company's making $300 to $400 million of free cash flow, $6 to $6.5 billion market cap, and they only pay a 1 to 2% dividend yield. So where's the rest of that money going? They do invest a bit of it in expanding their network, things like acquiring Vienna House a few years ago, things like building out Echo Suites, which is a new brand they want to launch. But where they put the most of their free cash flow is really in share buybacks. You can see here in the last 6-7 years, it's gone from 100 million shares down to 84 million shares as of September 2023. So it's probably closer to 83 million shares now. So they continue to buy back tons of shares, increasing your stake in the company, your stake of the free cash flow that they're generating over time. So really shareholder-friendly company, not only pays a decent dividend, but also has continued to buy back shares every single quarter over the last 5 or so years. In terms of their earnings, they're expected to do about $4.25 in earnings in this fiscal year, which is just wrapping up for them, and that puts them at about an 18 times earnings. And then if I go to next year, they're going to do closer to $4.70, which gets them, I believe, 16 to 17 times earnings. So not dirt cheap, but I'd say it's a fairly valued company, especially for how well they've been buying back shares and growing over the last few years. They do have some level of cyclicality to this company. At the end of the day, lots of their business is still focused on domestic, so the U.S. market, and within the U.S. market, kind of that economy scale. They're diversifying globally in a big way, still working on that for a disproportionate amount of their growth. They're looking at expanding into more mid-scale, upper-scale hotel chains, but the crux of the business is really in that domestic economy scale. So in times of a recession, those consumers will probably be disproportionately impacted. So there is some cyclicality. This probably won't go up like a straight line. There'll be some bumps along the way. But that's one of the reasons why I do really like the share buyback program, because hopefully they get in there and continue to increase your share in the company at times where it makes sense given the share price, if a crash was going to happen or a deceleration was going to happen. The second stock that I'm looking at buying more of in March of 2024 now is actually one that I've been adding to in February as well. It is Brookfield Infrastructure Partners. So this one's been on a bit of a wild ride. I was buying it down from $42 into the high 38s. Then it actually went down to into the 37s. And then it rebounded about 10% in 2 or 3 days. So this one's been pretty volatile over the last couple months, you can see. And it's also been volatile since the pandemic, really, with interest rates going up. That really impacted the valuation on equity of infrastructure companies. So you can see the choppiness that it's had. But this is a global infrastructure company here, currently paying out a 5.6% dividend yield. And they own tons of different assets that we're about to get into here, which I really like the exposure on. You can kind of see the breakdown of their FFO, which for these infrastructure companies is a better measure of profits than EPS, just because of all the accounting and depreciation and stuff like that. You can see about 29% of the business is in utilities here. In terms of transportation, that's about 40% of the business. They have some toll roads in Peru and Brazil and stuff like that. They have rail lines in different countries as well. And then diversified terminals, they have big part of the business, 22%. Big energy transportation business, 20% of the business. And then this is what they've been expanding to over the last year or two, trying to build out more data center capabilities. They think that's a big part of the future. They think it's been kind of come down to more attractive pricing on acquisitions there to add to the portfolio. So that's now already 9% of the business there. So not only are they involved in 4 different buckets of infrastructure, but they're very global in where their reach is. Lots of business in South America, lots of business in Europe and the UK as well. I think we're going to take a look at that right here. You can kind of see in the Americas, and a good chunk of that is South America with their toll roads and whatnot. It's almost 70% of the business. They have a business in Asia Pacific, about 15%, and then 20%, give or take, in Europe. Most of that is in the UK, I believe, but they have a couple other areas where they're focused on. You can see where the dots are their corporate headquarters, which gives you a bit of a sense of where they're operating and where lots of their assets are. So Brazil, probably Peru up there, a couple across Canada and the US, the UK, and whatnot there. Just a bit more information of what they actually own under each of these asset classes. So on utilities, they own, between electric transmission and natural gas pipelines, over 7,000 kilometers of line. On transportation, over 37,000 kilometers of rail, over 3,000 kilometers of toll roads, 7 million unit intermodal containers. I think that's part of an acquisition that they recently did. They own 10 terminals, 2 export facilities, midstream, over 25,000 kilometers of midstream assets. And then in data, I think they just acquired recently some telecom towers in India as well. So they own over 200,000 telecom towers around the world, 50,000 kilometers plus of fiber optic cable, and over 1 million fiber to premise connections, over 135 data centers overall. So pretty big exposure to each of these 4 buckets that they play in here. And then in terms of what their outlook is and what they're trying to accomplish, they cite 6 to 9% growth annually is what they're going after, and 6 to 9% dividend increases on an annual basis is what they're trying to achieve. And they've really held true to that over the medium term. It actually used to be higher. When I look at their dividend growth rate over the last 15 years or so, it's 10%. So they're at the high end or just exceeding the high end of this range. But their medium term outlook is this 6 to 9%. And that's what they've been doing over the last few years. It's combined with inflation indexation. So they have built-in inflation adjustments in contracts. But lots of the times, once they build a road or build the infrastructure asset, while it's more expensive to maintain maybe or replace, if from a replacement value equation, lots of that is just increased leverage, operating leverage, to get that increased inflation indexation on the same asset that they built already. Get a couple points from GDP, and then some of the cash flows that they don't pay out as dividends, which is a decent chunk of the cash flows, they reinvest in growth opportunities to accelerate the overall revenue growth and EPS growth of the company. FFO growth, rather, would probably be the best term to use. So in line with that 6 to 9% increase, they actually reported their 2023 earnings at the beginning of the month. I thought they looked pretty good. We can take a look in a second. But they did actually increase the dividend 6%, in line with the bottom end of that range. Some years they do the bottom end, some years they do the high end. Last year was a bit of a tough year for infrastructure overall, with all of the interest rate dynamics and everything else. So I was expecting probably the lower end, and that's what they provided. In terms of where the revenue came from last year, just scrolling up here for the summary, won't surprise you just based off of what we looked at the beginning. But you can see utilities really grew a ton, about 20% growth to $880 million. These are in US dollars, by the way. Transportation grew 10% as well to the same amount. Midstream actually shrunk as they sold off one of their US assets. And then data continues to grow as they make some strategic acquisitions in that area. When we look at the overall valuation of Brookfield in US dollars, which is what they report, they did about $3 or $2.90, I think, last fiscal year in funds from operation, and they're expecting to grow, that 5 to 10% range. So they're actually, when I convert to Canadian dollars, probably going to do about $4 and change of funds from operation in 2024, which gets this company, as I look at it, around 10 times, 11 times earnings, depending on where you buy it. So for a company that's growing 6 to 10%, has a track record of actually growing at that pace and passing it on to shareholders via dividend increases annually, and having the types of assets and in the types of geographies that they do have, I feel like buying at a low teens or a 10x multiple is a pretty good long-term play. And if they continue to execute how they have over the last 10, 20, 30 years into the future, especially with Brookfield as the driving force behind it as the managers, I feel pretty good about buying it at these levels. You can see here the stock in 2011 was at 11 bucks. Now it's at 40. I know it hit 50 when interest rates were a bit lower. So that's kind of maybe the short-term unlocked upside of interest rates crashing down. So I like getting in here. Pretty good valuation in my opinion, getting a nice secure yield, diversified backing of assets, and you're getting the price. You're getting the price that I deem to be a bit of a discount in my opinion, based off of where interest rates are right now. So if interest rates were to come down, I think it would go to 50 and beyond potentially, as long as they can continue to execute, since their funds from operations are higher than they were when the stock was up there at $50, $55 a share a few years back. Awesome. Going into the third and final stock I'm looking at adding this month, it is Riocan. Riocan is a retail REIT operating in Canada. You're getting a 6% plus starting dividend yield. They actually just increased that 2.5% in their year-end earnings report last month. So this is actually closer to 6.2, 6.3% now. And they continue to do pretty well despite lots of the overall sentiment on retail real estate. Looking at their business before going into their funds from operations here, you can see they have a 97.5% occupancy rate. They have tons of assets in the GTA here, about 60% of their total square feet. Just about 5% in Vancouver, 12% in Calgary, 5% in Edmonton, and then Montreal, 3.5%, Ottawa, 13%. So this is a very GTA-focused retail REIT at large. Looking at a bit of their exposure here, one of the reasons why I feel pretty safe with these assets in this company is lots of their exposure, they've slowly morphed over time into having very little exposure to areas of retail that will be impacted by things like Amazon, e-commerce, different types of experiences being sought after. 20% are grocery stores, pharmacies, liquor stores. If anything, with population growth, these companies are expanding, trying to get more presence, more of a footprint. 16% essential services, 12% value retailers. Those are stores like Dollarama who are growing super quickly in Canada. 10% experiential, which lots of consumers are flocking to those places to get experiences and entertainment. You can kind of see down here, specialty retailers. I think that even encompasses like Canadian Tire and whatnot. So it's still pretty good tenant base, 7.5%. It's quick service restaurants, which has been a growth area. Furniture and home, maybe one of the more risky ones at 6%. And then I think there's a couple percent in other tenants like Cineplex and whatnot that is obviously a bit higher risk. But for the most part, start adding these up. 80, 90% are, or 60, 70% are in a great spot, potentially needing to grow square footage over the medium term. Another 10 to 20% are probably in a solid spot. It's really only 10, 15% that maybe have challenges over the next decade or so. And there's a lot of room to recycle that space, give it more to Dollarama or other tenants that may have a bit more need for that space and a bit more healthy and sustainable of a retail presence. So overall, I think their client base is pretty solid and it's a bit overblown. People are thinking of like secondary, tertiary types of retail centers that are half extinct in random towns. That is not the type of real estate that this company owns for the most part. They also have a really strong pipeline. So right now, they're trading at about a 10 times earnings multiple. Their funds from operation is about $1.80, and the stock's trading at about $18 a share. And even if they didn't grow at all, you're getting a 10% funds from operation yield pretty much. But they are growing. They're only paying out 6% of that. They're taking the other 4%, and they're growing the business by expanding their residential rental business, their retail business. The office one is something that lots of people aren't too excited about. But lots of these office properties that they're building are part of multi-use areas. So it would be like retail at the bottom at a busy intersection, then maybe 24 floors of residential rentals, and then on top of that, they'd have office. I don't think they're building office-focused properties from scratch that are just like office buildings in random cities. These are in core downtown areas, and it's just complementary to the rest of the asset that they're kind of putting together. So that's really not a big focus for the company. They're really primarily focused on retail and then secondarily focused on residential, I'd say, from listening to lots of their earnings calls. But you're getting lots of this supposed growth for free because you're paying 10 times funds from operations for the company that's operating today without any of this realized into that earnings power. In addition to that, they've reallocated or repositioned their portfolio to be much more of a growth portfolio. So they have more rent kickers that will go up over time. They're more positioned in major cities, which are experiencing rent increases more prominently than those secondary cities. So the company, I think, is in a great spot where as interest rates go down, their debt expense is going to go down. They have a great pipeline of new assets that are coming in and going to be cash generative. And they've positioned their portfolio in major cities where they should be able to demand rent growth organically over time. You take all of that and put it on top of the fact that you're getting this stock for 10 times funds from operations today. I think it's a great opportunity to get 6% to sit on your hands and wait while all of those other drivers crystallize over the medium term, and you may end up with a stock that's trading at a higher multiple with significantly higher cash flows, and you just got paid 6% a year in the meantime as you got to that valuation level. So that's my personal thoughts on Riocan. As a disclaimer, Riocan is one of my biggest positions across my portfolios. So obviously I'm biased, but the reason why it's one of my biggest positions is because I do think that it is a great stock to own, and I do really like lots of these levers and drivers that they have for future growth of the company. Another common misconception is when people compare retail space in Canada to the US, this is something that they highlight a lot, but it's pretty notable that the retail square foot per person in the US is around 25, where in Canada it's about 17. So it's around 30 to 40% more already in the US. Retail naturally or organically wasn't built out as much in Canada as it is in the US. I think that's even more true for the major cities where we're very densely populated. So it's less abandoned shopping malls around the GTA, for instance, than there are in middle America, where you may be getting exposure and ownership of if you're buying retail REITs in the US, which is what scares lots of people off. That's really not the dynamic you're getting here in Canada and with these types of REITs like Riocan. And then lastly, just on their residential rental business here, I want to just be clear that this company is a retail REIT at the end of the day. The residential rental portfolio is complementary. It's something that, as they continue to densify their portfolio, I think will expand slightly over time. But I don't really see a day that the residential part is over 10% of their overall NOI or rental income. So you can see here from 2019, the growth that they've had, 700 units in 2019. It's got to the point where they're at about 3,000 units today as they continue to bring on more and more rental units. And at these levels, it's about 4% of their gross annualized rent. I think that's going to continue to go up every year as they bring these multi-use developments onto the market. So it could go 4% to 5% to 6%. I could see it getting to a high single digit or maybe 10% in the next 5 to 10 years. But I wouldn't necessarily buy the stock solely for this opportunity in residential rental. At the end of the day, they're really focused on delivering best-in-class retail real estate and partnering with their retail partners. This is really complementary, and in lots of cases to help build communities around those flagship retail centers that will create more demand for those retail partners. So a nice thing to know or acknowledge about the company, but not necessarily a future where this is going to turn into a residential REIT overall. Maybe they'll spin it out into a residential REIT after they build these centers so that they know that the people are going to be near their retail. But at least for the time being, it's just a nice little small cherry on top for this broader company that's trading at around 10 times FFO. Okay, I hope you guys like that depth that I went into on these three stocks that I'm looking at buying. Just to summarize, we got Wyndham here, not a stock I currently own. Brookfield's a stock I just started buying a few weeks ago. Brookfield Infrastructure Partners. And then lastly here, Riocan, one of my bigger positions in my overall portfolio that I think down here at 18 bucks is in a good position with that 6% starting yield and the growth drivers they have ahead of them. Thank you guys so much for watching. If you guys made it to the end of the video, be sure to give this video a big thumbs up. Helps a ton get these videos out to more people, and I really do appreciate it. Let me know in the comments your thoughts on any of these stocks or what stocks you're looking at buying this month, and I'll see you guys in the next one. Thanks.